Hi, this is Rowland from Money Markets TV. As we near the end of the year, I want to highlight one investment strategy that could help you make the best of a bad situation and put money in your pocket almost immediately. It's called tax loss harvesting. And to understand it, it may help to think about farming. When bad weather or insects damage a crop, farmers usually go ahead with the harvest anyway and try to salvage whatever they can. In the same way, adverse market conditions or unforeseen events can send one or more of your investments into negative territory. But like good farmers, smart investors acknowledge the loss, make the best of it, and move on. Suppose you sunk $5,000 into a stock last year and that investment is worth just $2,000 now. You have three options: ignore the loss and hope it gets better, sell and put your cash in a bank, or apply a tax loss harvesting strategy. If you think your stock will turn around, you may be tempted to choose option number one. But of course, your investment could keep getting worse. Option two is distasteful because it locks in the loss and means admitting a mistake. Plus, you run the risk of selling and then watching your stock zoom higher the next week. Tax loss harvesting gives you a third way. You might not recover your full investment, but you can at least minimize the damage. And the most amazing part is the IRS will actually help you do it. The U.S. tax code lets you deduct up to $3,000 in capital losses against ordinary income each year. This allows you to reduce your taxable income and save hundreds of dollars. So today, I want to give you three specific ideas for harvesting taxable losses. Number one, replace losing stocks with sector ETFs. Let's say you bought shares of Bank of America last year. You'd be sitting on a huge loss right now. But rather than eating the loss or doing nothing and hoping the stock turns around, you can sell your shares before the end of the year and buy an ETF covering the U.S. banking sector. Two candidates are Spider S&P Bank ETF and PowerShares KBW Bank Portfolio. In this way, you can make the best of the loss on Bank of America, but still benefit if financial stocks turn around. If you have a losing stock position with little hope of recovery, you might prefer idea number two. Replace losing stocks with inverse ETFs. Using the same example, you can harvest the Bank of America loss and then buy an inverse sector ETF like ProShares Ultra Short Financials. That way, if bank stocks keep falling, you can turn a continued loss into a big gain. Idea number three involves switching around your China ETFs. If, like me, you're bullish on China, you may be holding an ETF such as the iShares FTSE Xinhua 25. If you're sitting on a loss, if you want to harvest that loss, but still stay invested in China, you can sell FXI and use the proceeds to buy Spider S&P China. Because these funds are based on different indexes, it's legal to swap one for the other and benefit from the capital loss, but still get similar performance. Now, before you buy or try any of these strategies, think about the transaction cost. You'll be generating extra commissions with each buy and sell. Also be aware that you can't write off capital losses inside an IRA or qualified retirement plan. If you're holding open losses in any investment, tax loss harvesting may help you put extra cash in your pocket by early next year. I'm Ron Rowland from Money and Markets TV. Thank you for watching.